Welcome back to Money Matters, mastering finance and investment, and today we're tackling a topic that impacts many of us: debt. In this video, we'll break down what debt is, explore the various types of debt, and I'll share 10 valuable tips on how to manage your debt efficiently. Let's dive in. Certainly, let's delve deeper into the definition of debt and its various aspects. Debt, at its core, is a financial arrangement where one party borrows money from another with a commitment to repay it over time, often with added interest. This concept is the financial bedrock of countless transactions in both individual and business contexts. Key components of debt. 1. Borrowing money. Debt begins with one party, often referred to as the borrower or debtor, obtaining a sum of money from another party, known as the lender or creditor. The borrower may receive this money in various forms, such as a lump sum or in installments. 2. Promise to repay. The borrower makes a legal and contractual promise to repay the borrowed funds, along with any interest, fees, or additional charges as stipulated in the lending agreement. This promise is a crucial element that forms the basis of the debt. 3. Interest. In most cases, lenders charge interest as compensation for the risk they take and the time value of money. Interest is the cost of borrowing and is usually calculated as a percentage of the outstanding debt. It can significantly impact the total amount repaid over the life of the debt. 4. Specified period. Debt agreements typically outline a specific period within which the borrower must repay the debt in full. This time frame varies depending on the type of debt. For instance, a mortgage might span 15 or 30 years, while a credit card balance is expected to be paid off monthly. Forms of debt. Debt comes in various forms, each with its unique terms and implications. Here are some common types. Secured debt. Secured debt is backed by collateral, which serves as security for the lender. If the borrower fails to repay, the lender can claim and sell the collateral to recover the debt. Examples include mortgages and auto loans. Unsecured debt. Unsecured debt doesn't require collateral. Lenders rely on the borrower's creditworthiness and trust to repay. Credit card debt and personal loans are common examples of unsecured debt. Revolving debt. Revolving debt allows borrowers to access a predetermined credit limit and make multiple transactions up to that limit. Credit cards are the most familiar example of revolving debt. The outstanding balance can fluctuate as you make charges and payments. Installment debt. Installment debt involves borrowing a fixed sum and repaying it over a set number of months with fixed payments. Auto loans and student loans are typical forms of installment debt. Fixed rate debt. In a fixed rate debt, the interest rate remains constant throughout the loan's term, providing predictability in monthly payments. Fixed rate mortgages fall into this category. Variable rate debt. Variable rate debt has an interest rate that can fluctuate, typically tied to a benchmark, such as the prime rate. Adjustable rate mortgages, ARMs, are examples of variable rate debt. Understanding these nuances of debt is essential for making informed financial decisions. Debt can be a useful tool for achieving various goals, but it requires careful management to avoid financial stress and potential pitfalls. By comprehending the components and variations of debt, individuals can make informed choices about borrowing, repayment strategies, and financial planning to achieve their short-term and long-term objectives. Now, let's explore the different types of debt that you may encounter in your financial life. 1. Credit card debt. Credit card debt occurs when you make purchases using your credit card and don't pay the full balance by the due date. The remaining balance accrues interest. 2. Student loans. Student loans are designed to help with educational expenses. They come in two main categories: federal and private. Federal student loans often have more favorable terms. 3. Mortgage debt. Mortgage debt is the money borrowed to purchase a home. It typically spans over a long term and is secured by the property itself. 4. Auto loans. Auto loans are used to finance the purchase of a vehicle. They can be secured or unsecured, depending on the loan terms. 5. Personal loans. Personal loans are unsecured loans that can be used for various purposes, from consolidating debt to funding a wedding or vacation. 6. Medical debt. Medical debt arises from unpaid medical bills and can result in collections if not addressed promptly. 7. Payday loans. Payday loans are short-term, high-interest loans often used as a quick financial fix but can lead to a cycle of debt if not managed carefully. 8. Business loans. Business loans are for entrepreneurs and business owners to fund their operations or expansion. 9. Home equity loans. Home equity loans are secured by the equity in your home and can be used for home improvement or other expenses. 10. Overdraft and line of credit debt. Overdrafts and lines of credit are financial tools that allow you to spend more than you have in your account, but they come with interest and fees. 10 tips for managing debt efficiently. Now that we understand what debt is and its various types, let's move on to the heart of this video. 10 tips on managing debt efficiently. These tips can help you regain control of your financial well-being. Tip 1. Create a debt inventory. Start by creating a list of all your debts, including the type of debt, outstanding balance, interest rate, and monthly payment. This gives you a clear picture of your debt obligations. Tip 2. Set a budget. A budget is a crucial tool for managing debt. It helps you allocate your income to debt payments and other expenses. Be sure to include a category for debt repayment in your budget. Tip 3. Prioritize high-interest debt. If you have multiple debts, prioritize paying off high-interest debt first. This saves you money on interest over time. It's often a wise choice to tackle credit card debt or payday loans with high interest rates. Tip 4. Explore debt consolidation. Debt consolidation involves combining multiple debts into a single loan with a lower interest rate. This can make it easier to manage and potentially reduce your interest costs. Tip 5. Negotiate with creditors. Don't hesitate to contact your creditors if you're struggling to make payments. They may be willing to negotiate lower interest rates, extended repayment terms, or settlement offers. Tip 6. Build an emergency fund. Having an emergency fund can prevent you from going further into debt when unexpected expenses arise. Aim to save at least 3 to 6 months' worth of living expenses. Tip 7. Explore loan forgiveness programs. If you have student loans, look into loan forgiveness programs. These programs may offer forgiveness for a portion of your student debt if you meet specific criteria. Tip 8. Automate debt payments. Setting up automatic payments ensures that you never miss a due date. This can help you avoid late fees and maintain a positive credit history. Tip 9. Seek professional help if needed. If you're overwhelmed by your debt, consider seeking help from a certified credit counselor or financial advisor. They can provide guidance and resources to help you get on track. Tip 10. Stay committed. Managing debt efficiently requires commitment and discipline. Stick to your budget, make payments on time, and continue to explore ways to reduce your debt over time. The journey may take time, but it's worth it for your financial well-being. In conclusion, debt is a financial tool that, when managed wisely, can be a valuable resource. Understanding the different types of debt and implementing these 10 tips can help you take control of your financial future. Remember, you have the power to manage your debt efficiently and work towards a debt-free life. If you found this video helpful, please give it a thumbs up and subscribe for more valuable insights on personal finance and wealth building. Stay tuned for our next video, and thank you for watching. See you in the next one.